All right, let's get right into it. Today, we're doing a deep dive into corporate budget reporting. We're going to break down exactly how organizations build and communicate their financial game plans, all based on the LG document, the Budget Guide. So, before we get into the nitty-gritty, take a look at this. This isn't just a random collection of buzzwords. It's basically a map of the entire financial management world. You can see how terms like budget, variances, and stakeholders all orbit each other. It really shows you that this is all about how these different pieces fit together to steer the ship.
Here's the game plan for today. We'll kick things off with the absolute basics. What is budget reporting? Then we'll talk about how to present data like a pro, the right way to distribute reports, and finally, the really critical part, how to track and deal with any differences from your plan. It's the full picture from start to finish.
Okay, let's lay the groundwork. First things first, what are we even talking about when we say budget reporting? Why is it so absolutely fundamental to how a company works?
Here's the big idea. At its heart, budget reporting is all about communication. That's it. It's the official process of taking a company's financial plan and its real-world results and telling a clear, honest story to everyone who needs to know, from your investors all the way to your internal managers. The name of the game is transparency.
Let's make this real with an example. This table here, this is a classic budget report. And you can see right away, it's not just a list of numbers, it's telling a story. It breaks down what they think they'll make, what they think they'll spend, and where their cash will end up. This is where theory meets reality.
Now let's zoom in on that top-line number, $810,000 in projected total revenue. This is everything the company expects to earn, from their main sales to any other little income streams. It's the starting point for everything else.
And then we get to the famous bottom line. After you pay for everything, all your expenses, all your taxes, the company expects to have $78,000 left over. This number right here, that's the real measure of how profitable they think they'll be.
But having the right numbers is only half the battle. If you can't present them clearly, they're almost useless. So this next part is all about making sure your data doesn't just sit there, it actually makes an impact.
So how do you make dense financial data easy to understand? Well, you use a whole toolbox of formats. Tables are fantastic when you need to compare things side by side. Graphs and charts, they make trends pop right off the page. Summaries are for giving people the main points fast. And never forget footnotes. They let you add important details without cluttering up the main event.
Think of these as the golden rules for any report you ever create. You have to label everything, no mystery numbers. Keep your formatting consistent so it looks professional. Always provide context. What period are we talking about? And most importantly, give a summary of the key takeaways. You want to make it effortless for someone to know what matters.
All right, the report is written, it looks great. Now what? How do you actually get it to the right people? That's where a formal distribution process comes in. It's a structured way to make sure the right information gets to the right audience accurately and on time.
And here's that process laid out in 6 steps. It's totally logical, right? It goes from figuring out what you need to gathering the data, analyzing it, and then building the report. But I want you to pay close attention to step number 5, review and revise for accuracy. You cannot skip this. One mistake can tank the credibility of the entire report.
A budget isn't a document you create in January and then just file away. No way. The real work actually starts after it's distributed. This is all about monitoring the variance, that gap between your plan and what's actually happening, and turning that raw data into powerful insights.
So, what exactly is a budget variance? It's super simple. It's just the difference between what you plan to happen financially and what really happened. It's the score that tells you how close you are to hitting your targets.
Here's a perfect example. Let's say a company budgets $100,000 for marketing, but at the end of the quarter, they've actually spent $120,000. That $20,000 difference, that's the variance. And that number isn't just a fact, it's a bright red flag. It's a signal that something didn't go according to plan, and now it's time to find out why.
And that's exactly why keeping a close eye on these variances is so important. It lets you spot trouble before it gets out of hand. It gives you the hard data you need to make smart, informed decisions. It makes sure people are held accountable, it pushes everyone to get better, and it creates a culture of open, honest communication.
Okay, finding a variance is one thing, but our final section is about the most important part of the whole process. What do you actually do about it? How do you take corrective action?
So who's on the hook when things go off track? Well, responsibility is formally given to a designated person.
For departmental budget, that's probably the department manager. For the whole company, it's the board of directors. The critical thing here is that ownership is crystal clear. There are no gray areas.
And here is the system for actually handling those variances. You spot the difference, you dig in to find the root cause, you figure out how big of a deal it is, and then you create a plan to fix it. But look closely, it doesn't stop there. The last step is to monitor the results of your fix, which brings you right back to the beginning. It's a continuous loop. This is what active management looks like.
So, to wrap this all up, I want to leave you with a question to think about for your own work. After seeing this whole process, is your budget report just a static document that gets filed and forgotten? Or is it a living, breathing, dynamic tool that you use to actively make better decisions? Because as we've just seen, the whole point is to make it the latter.